stocks are recovering from yesterday's dramatic sell-off after the FOMC cut the Fed funds rate by 25 basis points. The S&P 500 today is up by 0.5%. The Nasdaq is up by 0.5%. The Dow has broken its 10-day losing streak, the longest losing streak since 1978. Gold's still down 1.5%. Bitcoin's down 5%. It's now trading below $100,000, and the 10-year yield continues to spike, up another 1.8%. The dollar is holding steady. Clearly, the markets were shocked by what happened yesterday. So what exactly did happen? And can the markets expect more surprises? I know that's an oxymoron. You can't expect a surprise, but maybe we can get a sense of how the Fed is thinking following recent economic data. We'll get someone who knows the Fed well. She is Danielle DiMartino Booth, CEO of QI Research. This episode is brought to you by Ground News. More on that later. Danielle, welcome back to the show. Always great to see you.
Good to see you, David. Happy to be back.
Yeah, happy day after Fed Day. I want to start with this clip from the FOMC. Take a listen. A reporter asked Powell about tariffs and their impact on inflation.
Great. And just a quick follow-up. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened.
Tariffs, he's right that we don't know the exact impact of tariffs and how many they will be or how big they will be and their impact on the economy, but we can we assume that their impact will not be zero on inflation?
I think that if we go based off of the past, with the preamble that Scott Bessent, incoming Treasury Secretary, he was all over the media prior to being named to be the next Treasury Secretary as saying he wants to slow play this process. He wants to give American companies a carrot, not a stick. He'd like to give them 2 years to onshore. And he wants, his philosophy at least is to go slow at this. Now, that's not, that nothing's to say that Trump's not going to defy his own Treasury Secretary and start writing executive orders on day one, on January the 20th. So we don't know how this is going to play out, but what we do know is what happened the last time tariffs were imposed. And we really didn't see any kind of appreciable difference in goods inflation for about 12 months, David. So it definitely takes time to trickle into consumer prices. And I would add that even the results of the trade war at the end of 2019 were such that global trade had turned negative. And in fact, the U.S. economy was headed into a recession of its own. And that the only thing that made the tariffs tenable for U.S. households was the fact that they had fiscal money, poured all over them starting in 2020 with the arrival of the pandemic. I don't know that we necessarily have a guarantee that there's going to be a repeat of that kind of stimulus spending, especially because we're hearing the exact opposite's going to happen, that they're going to try and reduce debt, reduce the deficits.
What is your outlook on inflation now? Here's CPI. We have the last print was 2.7 on headline. A lot of that was driven by shelter, though. Are you expecting the shelter component to continue pushing up the CPI, or can we expect other parts of CPI to pick up or perhaps stay relatively muted?
So, just based on the work that has been done by the Cleveland Fed, and that makes it a bit ironic, if you will, that it was the Cleveland Fed president as a rookie who came out of the gate shooting with her first dissent, which is kind of uncharacteristic of a new person, of a new voter on the Federal Open Market Committee, maybe because excuse me, maybe this was because it was her last vote for a while. But the Cleveland Fed's own research demonstrates that shelter inflation is going to come down from about 4.6% to about 2% year over year by the end of 2025. And in fact, David, we're hearing that occupancy levels. Ivy Zelman put a new survey out just today, on the day that we're filming this. Ivy Zelman put out a new report that shows that occupancy is at a record low in a survey that she's been running, I think, since 2001. And on top of that, if you listen to Class A and Class B apartment REITs in their earnings calls, they're also reporting that rents are coming down. So everything we see from the largest input to the CPI suggests that even if we do have tariffs manifest in goods inflation, right now, goods are actually deflating by 0.6% year over year. So even if that is to turn positive in 2025, you still have a downward trajectory for the inflation rate going forward.
Are you expecting then the inflation rate to come down a little bit lower towards 2% next year?
I am. I think that we're going to have some ugly base effects that are going to cause some year over year prints to be troublesome. But when it comes to a repeat of sky high car prices, for example, auto dealer lots across the nation are choking on way too many cars. We're seeing incentive spending rise very rapidly in order to try and get Americans into driving these cars. So the margins are shrinking there. We know that car prices are going to continue to come down. We won't have a repeat of automobile insurance rising at such a rapid clip. That requires regulators' approval, and that's why that kind of landed in one big, felled, gigantic inflationary swoop. And we've also got the likes of the CEO of Booking.com telling us that outside of the luxury sector, right, this is a K-shaped economy, outside of the luxury sector, that your average U.S. household is shortening the time that they're vacationing and planning much closer to when they're actually going to be taking that vacation and spending less. So, I couldn't count on one hand the sources of renewed inflation in 2025, and I happen to disagree with what the Fed determined in taking their inflation expectations upwards. Again, after we get past a few months of base effects, but that's just mathematics, and anybody can see through that.
If you want to read more about what happened at the FOMC press conference yesterday, check out Ground News, today's sponsor. Ground News is a fantastic news aggregator. They bring together sources from across the internet into one easy-to-use place. It saves me hours from having to search for different sources because once I have a story, I can see all the articles that cover that story in one homepage without having to Google various different sources. And they have a very interesting way of categorizing these sources with a bias distribution meter, for example. The bias distribution shows you what percentage of the sources are left-leaning, center-leaning, and right-leaning on the political spectrum. Their ownership meter shows you what percentage of the stories are owned by corporations or independent sources. Go to groundnews.com/David Lin, link down below, or scan the QR code here to get started. Use my Vantage plan. You'll get 50% off under $5 a month on a subscription. Great deal, great resource. Check out Ground News. We talked about tariffs. The other wild card may be energy. So we have geopolitical risks popping up all over the world: Syria, China, escalating tensions, trade wars, and the Ukraine war is still ongoing. I don't know if you think energy is going to spike and bring up CPI.
Well, we've actually seen the number of U.S. rigs that are working decline.
Right.
I think that is anticipated to continue on a decline as long as we don't see an appreciable rise in West Texas Intermediate, which we haven't, right? A lot of members of OPEC Plus that have been told to turn the taps off have not. They continue to pump out oil, and global demand for oil is in the toilet. So, if we do see an increase in oil prices, given what Trump committed to on the campaign trail, drill, baby, drill, it sounds like we're just going to turn a bunch of taps on here in the United States and be able to put a lid on energy inflation.
Turning back to the FOMC meeting from yesterday, Danielle, was it me or was Powell a little bit more cautious in signaling support for the markets at all costs? Whereas before, he may have been a little more, optimistic about the prospects of just boosting the economy. Now he's a little more reluctant to be accommodative.
Well, he certainly was not accommodative to investors. I found his views, and I found the views of members of the Federal Open Market Committee, though, to be quite disingenuous. For you to say that in July the unemployment rate was 4.243%, okay, fine. In November, the unemployment rate was 4.246%. The difference between the post-COVID high of unemployment is 0.007. And we have seen the unemployment rate kind of hit bottom and bounce back off. But to suggest that the unemployment rate is going to be coming down when you wake up to news that Big Lots is going to be closing 963 stores in a mass liquidation affecting more than 27,000 employees who are going to be laid off, and that Party City might not be behind it, and that Container Store might not be behind it. Either the members of the Federal Open Market Committee are not paying attention, or they're being disingenuous, one or the other, because we do not see the unemployment rate headed anywhere but further up.
So there was a question on unemployment. I'll get to that in a minute. But Powell, ultimately, why did the market sink yesterday?
I think Powell shocked the markets, which the markets were not prepared for. They might have been prepared for, and what I think a lot of people were anticipating was that the presumption of 4 rate cuts from the September dot plot would be reduced to 3 rate cuts. I don't think most market participants saw it coming that they were going to be cut in half to just 2 rate cuts.
Did the last CPI print didn't give any indicators to the markets as to what Powell may do?
The last CPI print came in right on the nails, exactly as what Wall Street was expecting. So no.
Could it be, this is a theory I've heard online, could it be
Sure.
that markets were shocked because, like you said, the last CPI print came in right on the nail? Powell just doesn't like Trump's administration. So he's shocking the markets because people weren't pricing in the attitude of the Fed towards the White House.
If that's the case, then shame on them, because starting with Jerome Powell, he has maintained that the Fed will not be influenced by politics and that they will not make monetary policy based on any type of political influence. And so therefore, if by process of elimination, right, because we know that inflation is going to come down next year, we know that unemployment is going to go up next year, then why on earth did they become so much more aggressive? Why did they become so much more hawkish if it wasn't driven by politics? Very bad optics, if you ask me.
Well, what's your take? Because last conference, not the one from yesterday, I counted 3 questions on whether or not Powell's getting fired. So,
Okay. And Donald J. Trump has come out and said that he's not going to fire Jay Powell.
Yeah.
So that kind of negates that risk, if you will. And even if he was to try to fire Powell, the constitutional precedent suggests he cannot, and that he would be secure in his position. Again, if Powell is supposed to be the guy not playing politics, he's not doing a very good job of it.
Take a listen to this question on the unemployment rate by this reporter at the conference here. We'll just play a brief clip.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about 0.5% rather recently. The question, I guess, is: do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so. No, I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market.
Okay, ongoing gradual softening. Can you just evaluate the other points that he made as well?
Well, I don't know what an ongoing gradual slowing in the labor market has to do with the Fed's projections, therefore, that the unemployment rate, which was rounded up to by 0.004 from 4.246, You round that up by 0.004, you get to 4.3. Therefore, their projection is that the unemployment rate is going to fall to 4.2%. And that does not, to me at least, communicate further gradual softening in the labor market. It actually communicates that there's going to be a heating up in the job market, and that we're not going to continue seeing these massive layoff announcements that we are continuing to see, by the way, unless he's blind.
Yeah. I mean, last time, a couple meetings ago, they were starting to prioritize the labor market. Is that still the case, Danielle?
Clearly, it's not the case anymore.
What's your outlook then for the labor market? Ultimately, can we see a scenario in which inflation comes down slightly per your projections, but the labor market deteriorates further? Would that reverse the monetary policy?
I think that's a base case assumption. The Philadelphia Fed research on its own last week put a report out that said that based on revisions that had been received, that job losses started in the second quarter of 2024. They said that jobs declined by 0.1% in the 3 months ended June the 30th. Any economist worth their salt knows that once job losses begin and future revisions play catch up to the data, that they continue going forward. And yet we have a complete deniability on Powell's part. Yes, I do project that we will see a rising unemployment rate and inflation begin to drift down as we get into 2025, and that the Fed will be forced to reverse course yet again. So they've gone from 4 rate cuts. Now they're at 2. I would suspect that by the time we get to March, then the dot plot then that's released is going to show a higher number of expected rate cuts in 2025.
In what scenario would they have to be prompted to raise rates?
Well, they'd be prompted to raise rates if the private sector is going to begin to hire people yesterday as opposed to fire.
Yeah, so that's not
certainly
happening.
not what insider selling is telling us is going to be the case, to say nothing of the Department of Government Efficiency, which plans to, put a dagger through the heart of the one area of the economy where we've seen job growth, which is government jobs. To be fair, that's been state and local government jobs where the real job creation has begun. But the state of Washington already announced last week that it was putting on a hiring freeze and freezing wages because all of the COVID era funding to the states and municipalities has dried up. So that source of job creation is going away in the new year. And it looks like the Department of Government Efficiency plans to start cutting federal payrolls.
And is it still too early to make assumptions on fiscal spending and fiscal stimulus? Because Scott Bessent does want, like you mentioned earlier, Scott Bessent does want the deficit reduced to 3% of GDP only. It's currently almost at 7%. And so that may imply less government spending, and they want tax cuts. So Powell may look at this or not and say, well, that's less fiscal impulse. We need more monetary impulse to keep the economy going.
And he appears to not want to help out this administration. But to your much more salient point, just extending the 2017 tax cuts that are set to sunset in 2025, that's $500 billion on its own that has to be paid for. And right now, the fact that they're going to the mats and trying to shut the government down is indicative of the new incoming administration not necessarily playing ball with this Congress or the next.
Turning now to my charts, we'll close off on the markets once more, Danielle. This is the 10-year yield. I was looking at the charts yesterday, and I had to recall 2022 when yields were rising and stocks were falling at the same time. Is that the scenario that we're seeing now going into 2025?
Well, it's certainly the scenario, which is not on your screen, that we're seeing play out in the rapid steepening of the yield curve.
Yes,
which tends to accompany recession. And yes, that is definitely a formula where you would see downside pressure in stocks, and that is backed by all of the news headlines that we've both been reading, David, that say that there are very few companies that are advancing in terms of their stock prices, and they're completely outweighed by companies that are seeing a declining stock price, which is highly unusual. Now we've had the longest string in the last 100 years.
Could you see the 10-year retracing 5%? That's what happened earlier in 2023.
It's possible that we see that. I don't think it's probable that we see that, because I think the market is starting to price in the damage that Fed policy could be inflicting upon this economy that is already in a fragile state.
Are you then raising your prospects or your chances of a recession by next year?
I'm not raising my prospects of a recession for next year. I'm actually hoping that, because history tells us that if the Philadelphia Fed has announced that job cuts began in the second quarter of 2024, that future revisions will show us that they continued throughout 2024. The way recessions work, David, is the recession begins several months before job losses begin. That would put it in March, April, May of 2024. I'm actually looking for the recession to end, with any luck, towards the middle of 2025. But again, it took the National Bureau of Economic Research 366 days to announce that recession had started after it had begun in December 2007.
Right. So basically, we're already kind of in it, and this is just the tail end. And we're going to.
Well, we hope it's the tail end. The average length of recession is about 11 months in the post-war era. The Great Recession lasted for 18 months. And again, I would remind you, as to what I just said a few minutes ago, we're looking down the barrel of job losses in the government sector.
What do you think the Fed's going to do once, let's suppose you're right, data comes out and we've been in a recession all along? Are they going to look at the rearview mirror and say, well, maybe we have to adjust monetary policy because official data has now come out, or they're just going to look past it and move on?
I think really it's going to depend on how the incoming data is faring. Once you start to come out of recession, job losses continue, and the Fed tends to chase its tail down that path and continue easing even after the economy has technically exited recession.
Your top assets for 2025 then, given your outlook?
As I have been saying, if you are quite certain that you own stocks where the dividend is going to be safely paid, and not be at risk, then buckle up, put your seatbelt on, and continue to hold those cash income producing types of stocks. I still think gold is a good play going into 2025. We've certainly seen volatility get shaken up, and that is, in these types of environments, gold does tend to outperform. And any kind of a bond that again, this coupon's good. Clip that coupon and take it, and as long as you've got income that's attached to your investments, I think that's where you need to be. You can be postured defensively, but still have a portfolio that is throwing off cash flow.
All right. Very good. Thanks very much. Tell us about QR Research, where we can find you.
Well, yes, please. I'd love you to come to my Substack, dmartinobooth.substack.com. For new annual subscribers, we're maintaining 20% off that annual rate through the end of the year. Happy New Year. And if you don't already follow me on Twitter, please do, at DiMartino Booth. And if you're an institutional investor listening to Mr. David Lynn, then reach out to me directly. We'd love to have you as a QI Pro institutional client.
Well, give us a teaser. Give us one topic that you're working on right now that we can expect.
So one of the topics that I'm working on right now is the unexpected increase in existing home inventories, and how that is colliding with new home inventories that are already a 9.5-month supply based on current sales, and what the implications are going to be in the new year as your home investors, your Airbnb jocks, as financing for these individuals continues to dry up, and what the implications are going to be for home prices, for shelter inflation, and further downside risk in that arena.
Right. Very good. Thank you. We'll put the links down below, so make sure to follow Danielle there. And of course, she has social media. We'll put the links there as well. Appreciate it. Happy New Year. Merry Christmas. We'll speak again next year.
All of those same things to you. Merry Christmas, happy holidays, happy New Year, David. Talk soon.
Thank you. Thank you for watching. Don't forget to like and subscribe.